The stock market can seem intimidating at first glance. With its fast-paced environment and constant fluctuations, it's easy to feel overwhelmed. It's a whirlwind of numbers, charts, and jargon that can leave even the smartest person feeling lost. Terms like bull market, bear market, and dividends might sound like a foreign language. But don't worry, it's not as complicated as it looks. With a little guidance, you can navigate this financial landscape with confidence. This guide will break down the basics of the stock market in a way that's easy to understand, even if you're a complete beginner. We'll start with the fundamentals and gradually build up your knowledge. Think of the stock market as a giant marketplace where companies go to raise money. Just like a farmer's market where vendors sell their produce, companies sell shares of their business to investors. When you buy a stock, you're essentially buying a small piece of ownership in that company. This means you have a stake in its success and sometimes a say in its decisions. As the company grows and becomes more profitable, the value of your stock goes up and you make money. This is the essence of investing, putting your money to work in hopes of earning a return. Of course, the opposite is also true. If the company doesn't do well, the value of your stock can go down. This is why investing always carries some level of risk. That's why it's important to do your research and invest wisely. Understanding the company's business model, financial health, and market conditions can help you make better investment decisions. This guide will give you the tools you need to make informed decisions about your money. From analyzing financial statements to understanding market trends, you'll gain the knowledge to invest with confidence. We'll cover everything from opening a brokerage account to choosing the right investments for your goals. Whether you're saving for retirement, a new home, or just looking to grow your wealth, we've got you covered. So sit back, relax, and let's demystify the world of the stock market together. By the end of this guide, you'll have a solid foundation to start your investing journey and make your money work for you. Before we dive into the nitty-gritty of investing, let's define some key terms. A stock and a share are essentially the same thing. They represent a unit of ownership in a company. When you buy 100 shares of Apple stock, you own a tiny fraction of Apple. A market index is like a scoreboard for the stock market. It tracks the performance of a group of stocks, giving you a general idea of how the market is doing. Some well-known indices include the S&P 500, which tracks 500 large companies, and the Dow Jones Industrial Average, which tracks 30 major companies. Understanding these basic terms will help you navigate the world of investing with confidence. These are the building blocks of market knowledge. Don't worry if it takes a little time to fully grasp them. We'll be using these terms throughout the guide, so you'll have plenty of opportunities to reinforce your understanding. Now that you know the basics, let's take a peek behind the curtain and see how the stock market actually works. The stock market is a complex system, but at its core, it operates on a few fundamental principles. Stock exchanges, like the New York Stock Exchange, NYSE, and the NASDAQ, act as marketplaces where buyers and sellers come together to trade stocks. These exchanges provide a regulated and organized environment for trading, ensuring transparency and fairness. Think of it like a giant auction house, but instead of bidding on art or antiques, people are bidding on stocks. Each stock represents a small ownership stake in a company, and the price of the stock reflects the market's perception of the company's value. When you place an order to buy or sell a stock through your brokerage account, that order is sent to the exchange, where it's matched with a corresponding order from another investor. This matching process is facilitated by sophisticated algorithms and high-speed computers. This entire process happens electronically, so trades can be executed in a matter of seconds. The speed and efficiency of electronic trading have revolutionized the stock market, making it more accessible to individual investors. The price of a stock is determined by supply and demand. When there are more buyers than sellers, the price goes up, and when there are more sellers than buyers, the price goes down. This dynamic is constantly changing as new information becomes available and investor sentiment shifts. If more people want to buy a stock than sell it, the price goes up. This can happen for a variety of reasons, such as positive news about the company, strong earnings reports, or general optimism about the market. Conversely, if more people want to sell than buy, the price goes down. This can be triggered by negative news, disappointing earnings, or broader economic concerns. The stock market is highly sensitive to news and events, both domestic and international. This constant fluctuation is what makes the stock market both exciting and unpredictable. Prices can change rapidly, and investors must stay informed and be prepared to react quickly to new developments. Understanding these mechanics will give you a better appreciation for the forces that drive stock prices. By learning how the market operates, you can make more informed investment decisions and develop strategies to manage risk. It's like learning the rules of a game before you start playing. The more you know about how the stock market works, the better equipped you'll be to navigate its complexities and take advantage of opportunities. So, take the time to educate yourself, stay updated with market trends, and always be ready to adapt your strategies as the market evolves. With knowledge and preparation, you can become a more confident and successful investor. Section 4. Your first steps to investing. Setting goals and choosing accounts. Ready to start investing? Great! But before you jump in head first, it's crucial to set clear financial goals. Are you saving for retirement? A down payment on a house? Your child's education? Knowing your why will help you determine how much to invest, how long to invest for, and what level of risk you're comfortable with. Once you have a goal in mind, you'll need to open a brokerage account. This is where you'll hold your investments and make trades. There are many different brokerage firms to choose from, each with their own fees and features. Do your research and compare options before making a decision. Remember, investing involves risk. It's possible to lose money, especially in the short term. But with careful planning and a long-term perspective, the stock market can be a powerful tool for building wealth. Are you ready for the next step? Section 5. Building your portfolio. Stocks, ETFs, and mutual funds. This section is crucial for anyone looking to grow their wealth over time by making informed investment choices. Now that you have a brokerage account, it's time to start building your investment portfolio. This is where the real journey begins, as you start to put your money to work in various financial instruments. But with so many different investment options available, it can be tough to know where to begin. The sheer volume of choices can be overwhelming, especially for new investors who are just starting out. Let's break down some of the most common investment types: stocks, ETFs, and mutual funds. Understanding these can help you make more informed decisions and build a diversified portfolio. We already know that stocks represent ownership in individual companies. When you buy a stock, you are essentially buying a small piece of that company, which can appreciate in value over time. But what about ETFs and mutual funds? These are collective investment schemes that pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. They are like baskets of stocks that track a particular market index, sector, or investment strategy. This means you can invest in a wide range of assets without having to buy each one individually. For example, an S&P 500 ETF would hold all 500 stocks in the S&P 500 index, giving you broad exposure to the large-cap U.S. stock market. This can be a great way to diversify your investments and reduce risk. Mutual funds are similar to ETFs, but they are actively managed by a fund manager who buys and sells stocks on behalf of the investors. This active management aims to outperform the market, but it also comes with higher fees. ETFs, on the other hand, are typically passively managed, meaning they track an index without any human intervention. This passive management usually results in lower fees compared to mutual funds. Each investment type has its own pros and cons, so it's important to consider your individual needs and goals before making any decisions. Stocks can offer high returns but come with higher risk. ETFs provide diversification at a lower cost, while mutual funds offer professional management but at a higher fee. Don't be afraid to consult with a financial advisor if you need personalized guidance. A professional can help you understand your options and create a strategy that aligns with your financial goals and risk tolerance. Investing is a journey, and having the right support can make all the difference.